So with the markets holding at all-time highs, the IPO market booming, and the Federal Reserve possibly entering a rate cut cycle, although that is not guaranteed, what's the trade? Let's get right to the floor show. Northern Trust Asset Management Chief Investment Strategist Joseph Tanious is with us right now. $1.3 trillion in assets under management under your roof there. Let me get right to it, Joe. Can you give me the temperature gauge you see for the markets going forward to see four records, Dow, NASDAQ, S&P, and Russell right now? Does that give you excitement or a little bit of hold up? Maybe it's time to start moving some investments around, and if so, which ones?
I think it gives me a little bit of excitement, a little bit of encouragement. I mean, if we just take a step back here and ask ourselves for a moment, what exactly is driving markets to these all-time levels? I think there are a few fundamental forces in play. One, as you touched on, of course, we have the Federal Reserve finally coming back into a rate-cutting cycle. Now, as Jay Powell made it very clear, this is not the beginning of sequential rates to come. At least that is not guaranteed, but we are moving in that direction. We also have a meaningful amount of fiscal stimulus, which is expected to hit into the system in early 2026. That's certainly going to be supportive and encouraging. And then lastly, just again, focusing on the underlying fundamentals. Take a look at what's happening with earnings. Take a look at earnings estimates for the S&P 500 and even for small cap, candidly, as you start to look out into 2026. We're expecting to see a broadening out, if you will, of participation across corporate America. And we think all of these things are just supportive to risk assets and are carrying markets to these levels that we find ourselves at today.
But did you fully interpret yesterday from Jay Powell's comments that we are free and clear for a rate cut cycle? Because if you look at bonds right now, bond yields are moving higher. The 2 and the 10 are up, and the 10-year is just pretty much at about a 2-week high. And that does not indicate that the bond market believes that there's going to be more cuts, at least coming up.
Yeah, it's interesting when you take a look at the output, if you will, of the Federal Reserve meeting yesterday. We only had one dissent. Which is an encouraging sign, right? It certainly suggests that we are starting to see a bit more stability, a bit more unanimous voting, if you will, on behalf of Fed voting members. And that's an encouraging sign. But let's be very clear. The balance of risks has certainly shifted towards the labor market as the labor market has softened. But the U.S. economy does not appear to be heading into a recession. I think when you take a look at even the Fed's own estimates, their own estimates haven't materially changed as far as economic growth. They believe the U.S. economy is certainly moderating. We're seeing slower economic growth heading into the early part of 2026, but it isn't necessarily capitulating. We're not expecting to see the economy contract. The big wild card out there, and I think what's holding the Federal Reserve back from providing more accommodative monetary policy and even being more aggressive, if you will, in cutting interest rates, is the uncertainty around inflation. We are seeing inflationary pressures creep up a little bit higher. And of course, we are expecting that number to continue to inch higher into the early parts of 2026 as the effects of these tariffs, if you will, finally feed through into consumer price index.
Yeah, that I think is something to really watch. And that plus, as you mentioned, earnings are a good barometer, are they not? Great to see you, Joseph. Thank you for joining us.